Hi there, welcome to Dream Invest and welcome to another answer and reply video. I've had a busy morning. I decided to participate in the Harrington Parkrun. It's called a Dungar Reserve Parkrun. I did this parkrun for the first time 2 weeks ago. I came about sixth. And this morning, there was only like 19 runners. Yeah, about 19 runners. And yeah, if you really want, and you're a runner, and you really want your ego stroked, maybe come to this particular park run because I did come first with a time of 23 minutes, 56 seconds. That's quite slow. Wouldn't say that is fast. And in fact, I ran 18 minutes, 25 seconds. That's my quickest time at park runs in Brisbane. And only twice have I come first with that quick of a time. Sometimes I would run like 18 minutes, 30 seconds and come 10th. So it all depends on your park run. But if you're a runner, it's a beautiful course as well. One thing I don't like about it, it's out and back, out and back. So you do 4 laps. That's the one thing I don't like about it. But it's run along the Manning River, a beautiful course, and I suppose it's wonderful people, even though I don't talk to anyone because that's not who I am. Anyway, so if you want your ego stroked, I suggest maybe running Park Run at Dungar Reserve in Harrington. Anyway, let's go and have a look at your first question. That's the whole point. And actually, comment. This is from Forest Hill, who says, didn't you know you're a fellow Bills fan? Go Bills. For your information, the ASX staggered trading at open will cease as of Monday. Thank you for that information. If I read this particular comment before Monday, I would have been shocked and surprised when Monday started trading. Anyway, Forrester also mentions in a reply to Sensei that he or she lived just south of Buffalo in the late 1990s. I lived near Buffalo in the late 1990s as well. Actually, from January 1999 through to the summer of 2001, I lived just to the east of Buffalo. In fact, let's bring up the map. I brought this up. So Buffalo, there's Buffalo and Rochester, New York. I lived just to the west of Rochester, a little town called Brockport. In fact, my girlfriend, through about 1 or 2 years, maybe not as long as 2 years, but my girlfriend at the time did come from Buffalo. And one of the reasons I actually do go for the Buffalo Bills is because she and her family were massive Buffalo Bill fans at that point in time. And for some reason, probably because Buffalo was a small market team, they hadn't won anything. They lost 4 years in a row. I felt they were an underdog. And I remember watching Buffalo play the Tennessee Titans in a playoff game. It has a name. It has a name. Buffalo versus something Miracle. I still remember watching this, even though it was many, many years ago. I think it was in 2000 and no, 19, or it was either nine. Oh, it would have been early 2000. Game playoff. What was it called? Playoff Miracle playoff. Music City Miracle. Buffalo took the lead, and on the final play of the game, they kicked off, I think, and Tennessee threw a lateral and won the game in the final second. And I just remember how distraught everyone was in her family. And I think that's when I started supporting the Buffalo Bills because, yeah, I like the underdog. Really like the underdog. The other thing I should mention is I started supporting Buffalo Sabres, which is an NHL. And the reason I started following them is because they were in the Stanley Cup finals that year as well, or maybe the previous year. So Stanley Cup 1999, I think. And they lost to, if I remember correctly, they lost to Dallas. They lost to Dallas. Yeah, Buffalo Bills or Buffalo Sabres losing to Dallas Stars in the Stanley Cup, and they haven't been anywhere near the Stanley Cup finals since. That was probably just after I moved there, if I remember correctly. So that would have been, yeah, June of 1999, just after I moved there. Anyway, so I lived in Brockport for about 2.5 years. The main thing I remember from that little stay is how much snow, and I love snow, still love snow. At one point, because you get a lot of lake effect snow, particularly downwind of the lakes. So Buffalo gets a lot of lake effect snow if the wind is southwesterly, going across Lake Erie. Rochester or Brockport gets a lot of lake effect snow if the wind is either a northeasterly or northwesterly. And I do remember getting 4 feet of snow in about 2 days. Now, that was a combination of synoptic and lake effect snow. And I remember going out for a walk in a blizzard. Going out for a walk in a blizzard. I just wanted to see what it felt like. Never again, never again. But I did get sick of snow eventually by the end of winter or start of autumn. But I will not regret, not would never regret my time in that part of the world because I loved it. I loved living there. And the other thing is, summers were beautiful. Summers were absolutely gorgeous because the climate there were tempered. The summer climate was tempered by the lakes, so just being on the lake. So never regret living, never. I wouldn't say I miss living there, but definitely don't regret living there. The other thing a lot of people don't realize is I'd tell people, my friends that live in New York State, and they'd say, "Oh, I'm in New York City, just come for the day." And I have to tell them I live 6 hour drive from New York City, so it cannot be a day. It cannot be a day. Yeah, from where I lived to New York City was about 6 hour drive. Anyway, let's move on to the next question. So thank you. We could have been living in the same area at the same point in time, Forest Hill. Anyway, Sensei 6011 says list verbally in one go which exact team you support in NRL, AFL, BBL, A-League, IPL, State of Origin, NBA, MLB, NHL, NFL, MLS, EPL, La Liga, the exact country you support in a 4 yearly soccer World Cup if Australia or US is not in it, competing, the country you support in the 4 yearly Rugby Union World Cup. So let's do this. Let's do this. So NRL is easy. Parramatta Eels. Simple reason there is I was born in Parramatta. That's it. AFL, I don't support a team in AFL. So for me, the team I support must come naturally. It can't be forced upon me. And when it comes to AFL, hasn't been any natural path for me to go down to support a team. Maybe the closest would be Richmond, because for some reason, when I was really, really young, I thought Richmond in the AFL was the little town or suburb of Richmond in Sydney. There's a RAF base there or something there. And then I realized that's the wrong Richmond. But other than that, like no Sydney team I support, no Brisbane team. No, I don't support anything when it comes to Queensland. I'll give you that much. So yeah, I don't support any team in AFL. And that is a theme here. There are some competitions where I don't support a team. BBL, probably I don't really follow the BBL all that closely in terms of supporting a team. Maybe the Sydney Thunder just because they have the Thunder name, but I'm not that passionate when it comes to the Big Bash. A-League, no, I don't support any team in the A-League. Yeah, I don't support any team in the A-League. Yeah, again, nothing has really happened to me where I will support a team. For instance, in the NRL, I was born in Parramatta, so therefore I go for Parramatta. IPL, again, I don't support any team in the IPL, the Indian cricket. Again, I just don't have an affinity for any team, just like A-League and the AFL. State of Origin, that's easy. New South Wales, and by the way, I should also mention once I start following a team, that's it. I'll follow that team forever. So yeah, so State of Origin, always support New South Wales no matter what. NBA, this is one where I wasn't following a team, and then the Seattle Supersonics moved to Oklahoma. They became the Oklahoma City Thunder, and I started supporting that team. That was a very natural fit for me because I lived in Oklahoma for moved there 2001, yeah. So I lived there for about 4 years, and that was a very natural fit for me. And go Thunder, they won the NBA this year. Go Thunder, a small market team winning the NBA, absolutely great news. Major League Baseball, this is another competition. I don't follow a team. In fact, you could say I follow any team that's playing the New York Yankees and maybe these days the LA Dodgers because I just don't like how the NBL is run, MLB is run, that you have these large market teams that spend way more of their way more money on their payroll than the small market team. So there is a definite, I suppose, definite bias towards the big market teams, and that's New York Yankees, LA Dodgers. So I don't support those teams. It's just too easy. It's just too easy to support those teams. I prefer the battler. I prefer the team that is in small market, that sort of thing. Major League Soccer, yeah. Oh, before that, NFL, definitely the Buffalo Bills. I do have a soft spot for the Philadelphia Eagles just because my dad comes from Pennsylvania. So I do have a little bit of an affinity with Pennsylvanian teams. So, Philadelphia Eagles, not so much the Pittsburgh Steelers, just because they were so good for so long in the 70s, maybe the 80s, definitely the 70s. And I do know a lot of people who support them. So, I do prefer the Philadelphia Eagles. In fact, they've won this year as well. When it comes to university sports, University of Oklahoma, just because I went there for 4 years, and one of the big differences between the United States and Australia is when you do go to university, for some reason, I think it's to do with sport, you do have or develop a really deep affinity to that university. Now, I went to the University of Newcastle. It doesn't I don't have much an affinity with that university. Went to SUNY Brockport, which is a Division three university. I do have a little bit of affinity with that particular university, but Oklahoma, oh yes, I have a real big affinity with Oklahoma, and a lot of that is because of the sporting culture over there. So I do support everything University of Oklahoma. Their softball team won 4 years in a row. A very good gymnastics women's team, and even their football team has done well over the last sort of 60 or 70 years. Anyway, so that's that. Major League Soccer, nothing there. I couldn't even tell you the teams, to be honest with you. EPL, this is easy. Manchester United. And the only reason I support Manchester United is because I watched an FA Cup final. Manchester United versus someone else. And this would have been when I was really young. So I must have got up really early for some reason. Maybe I liked soccer, really liked soccer at that point. I wouldn't do these days. I would not get up early in the morning, like 2 o'clock in the morning to watch sport. Just don't do it these days. I'm different. And I just remember there was a really, I suppose, perceived bad call against Manchester United. I thought they were screwed. And from that moment on, I just started supporting Manchester United. I didn't realize they were probably a big team. They won a lot after that. Not so much last maybe 5 or 10 years, ever since Alex Ferguson retired. Sir Alex Ferguson. La Liga, no, don't have any affinity for any Spanish teams. The exact country you support in a 4 yearly soccer World Cup if Australia or USA is not in it competing. Definitely support Australia. That's it. Australia, when it comes to soccer, definitely support them. And again, they're underdogs. They're not expected to do well. So we'll support them. Now, here's something interesting. I'm half American, half Australian, and I do not support USA in anything. Nothing. Absolutely nothing. And the main reason is they're not much of an underdog. Well, maybe in soccer they are, but in soccer, yeah, I don't really care about USA in that. But when it comes to the Olympics, very anti-United States in all events. I will go against anyone who is not United States or representing United States. So I'm definitely not Team USA, and I'm always supporting Australia when it comes to Olympics, most sporting events, but not all sporting events will I support Australia, particularly if they are dominant in that sport, like rugby league. I don't support Australia in that. Uh, on occasion, I don't support Australian cricket either, particularly if I think they're getting a little bit arrogant. Like in the 1996 World Cup against Sri Lanka, I supported Sri Lanka that. I wanted Sri Lanka to win because I thought Australia at that point was getting a little bit, they were getting a little bit arrogant. Now, in saying that, if Australia is playing India or England in cricket, I will always support Australia. There was no way I will ever support India or England when it comes to cricket. And the country sport in the 4 yearly Rugby World Cup, I suppose Australia, but yeah, couldn't care less about that. Anyway, so any other sports out there? Yeah, that's about it, I suppose. Stu Percy says, "Hi, Neppy." Nappy. You do apologize later, by the way. It doesn't matter. Not sure if you answered my question previously, so I'll ask it again. Are you worried about going to America with all the riots? I have answered this. I have answered this. And my answer to this is no, I am not concerned at all because when I do go to America, when I do go there, I would not be going to or staying in any big cities. I'll be going to small cities, natural parks, forests, that sort of thing. So I don't care at all. And even entering into the United States, because I do have an American passport, I will be let through fairly quickly and fairly easily. Won't have to answer any questions, that sort of thing. In fact, they'll say to me, "Welcome back." They'll say, "Welcome, sir. Welcome back to the United States, sir." or welcome back to the country. So they're very nice to American citizens, not so nice to people who aren't American citizens. And I know this because when me and my ex-partner went from Canada to the United States in 2017, they treated me with undue respect. They did not treat her with undue respect. In fact, they questioned her so deeply. But they said to me, welcome back to the United States, sir. And then they said to my partner, where are you staying tonight? And she had no idea because I was planning everything. And I actually said the name wrong. There's a little town called, or spelled Sequim, and I said Sequim. No, the E is silent. It's actually pronounced Squim. And actually, they did make fun of me because we actually had to go inside because I had to question my partner. Weird. Anyway, so I have no concerns. And when I actually do go to LA, I'm flying into LA. I'll show you this. The problem is when I go to LA, flying to LA, I'll be flying in at about 2 to 3 p.m. So it's near peak hour traffic. And if you know anything about LA, traffic is horrendous. But I am going to an REI store just south of the airport. I forget where it is. It's just south, somewhere here. And I'll stay there, maybe do a little bit of shopping, maybe have dinner just south of the airport. But I plan to then spend the night at Pasadena, so I can do a hike or somewhere just east of Pasadena. So I can do a hike the next day. Not Mount Baldy, but anyway, so I don't intend to spend much time in cities. And again, if I had a choice in the United States, I will stay well away from cities and just spend my time in small little towns and natural places. Anyway, let's move on to Capil Seth. Nice video. What are your thoughts on McMillan Shakespeare 5% share price move on Friday? So we're talking about Friday 1 week ago, not Friday on the 27th of June. Let's have a look at the chart for McMillan Shakespeare. Is this chart looking interesting? I do know FPR chart, Fleet Partners, does look interesting. And so this is the opposite direction. I thought you meant the price is up. Yeah, it was down 5.87% on Friday the 20th. Why did that happen? Is it any reason? Did they go ex-dividend, which probably would be not that likely? No. If you look at the trade history, it was just down a fair bit. High volume on that day. So you can see 717,000 shares traded on that day, and all last week it was between 150 and 200,000 shares. So that's abnormally high volume. It could be just like a fund manager selling on market, and that's it. That's all it can take for share price to drop like that. I don't think the chart's looking bad, and we have seen the share price go up since then. It's not my favorite chart, but it's not overly bad. I do prefer Fleet Partners. I don't mind this one if it comes up. Just take your time. Training view. Here we go. Oh, sometimes you just have to refresh it. There we go. I actually don't mind this chart. In fact, Fleet Partners and McMillan Shakespeare, even though they're not identical, there are a bit of similarities between the two. And I would probably also suggest there is a possibility both companies are quite cheap. Like Fleet Partners has a P ratio of 9.4, doesn't mention a dividend yield. And I would assume McMillan Shakespeare has a probably P ratio just above that and probably a nice dividend yield as well. I don't think you're going to see much growth in these companies. And yeah, for some reason, TradingView is really slow. Really slow. It's not because... Do you know my background? It's Dracula or a vampire fighting a predator. Yes, I just asked Sora to do me a picture of that. Anyway, so McMillan Shakespeare, dividend yield of 9.64%, P ratio 11.91. So there's a chance that these companies might be cheap, but they're not growing all that much. Anyway, so no real significant thoughts on McMillan Shakespeare. Anyway, Happy Now says, thank you for another video. Oh, the good old MTM chart. Anyway, so let's have a look at the MTM chart again, because I think the share price has pulled back, and I would have expected to pull back eventually with MTM Critical Metals. I'm pretty sure they did a couple raising, which is exactly what they should have done. Yeah, the share price has pulled back, but is this a buy the dip situation? Is this a buy the dip situation? How long has this pullback got to go? Another thing you might do is just have a look at the volume. No big volume coming through. so people aren't really panicking. So I always like to have a look at the MTM critical chart because of happy now. And there you go. Rick Thelian mentions, yes, if you bought CSL in 1995 below $1, hence you get twice your original investment from last dividend for 6 months. JustJamesDean also mentioned Paul Clitheroes, host of Money Dad, is a doctor. He thought the small biotech company was good, poured his savings into the IPO. Boy, I bet CSL's done well. You'd be very wealthy today. So will the taxman through dividends would have covered his IPO price. Paul Lithrow bought a yacht for Sydney Twilight Race. Thank you, CSL. So the whole reason this was discussed is because that's my dream, is to buy a company and eventually the dividend is more than your initial capital. And you need to buy growth companies. You can't buy like a company like CBA or Telstra. That will never happen. Even though share price of CBA has gone up a lot, the growth in that company is just not great enough. So the dream is to buy a company whose share price and growth is enough that eventually, and the dividend growth is enough that eventually your initial capital is smaller than the dividends you get every single year. Even every single 6 months, that'll be even a better dream. Archie McCauley says, Axon, an American body cam company that is trading at a crazy high multiple right now, but has some insane growth you should look at. It's really interesting because just a few posts later, Sensei 6011 says, thoughts on Axon was $88 in mid-2022 and now $777, as mentioned by Archie McCall in the comments too. Oh, there you go. So that's probably why Sensei mentioned it. So let's have a look at Axon. Axon Body. I have heard about this company, Axon. What I'm going to do is just have a look at the some of the metrics, financial metrics, and I think I'm going to be pretty impressed. So first thing I do, and this is the first time I looked at this company, by the way. So current share price is $818. So share price is a 10 bagger over a fairly short period of time. So yeah, mid 10 bagger, almost a 10 bagger over the last 3 years. We'll have a look at the chart in a second. So revenue growth. First thing I look at, revenue growth. 3 years, 34%. 5 years, 31.7%. 10 years, 29.1%. So in fact, the revenue growth is accelerating just based off the 3, 5, and 10 years. Earnings per share growth. This company has found some leverage. What's the other word? So operating leverage, some scale. And we can see that just by the earnings per share growth. Over the last 3 years at 88%, over the last 5 years, 169.3%. You can definitely see why the market has got excited about this one. I just wish I discovered this company 3 years ago. Even do they have, no, they don't have dividends, which is okay. You probably don't want a dividend at this stage in their life. If this company was on the ASX, they probably would have a dividend and that would suppress their growth and their growth and their innovation as well. Anyway. Gross margin 60.6%. I would assume that is rising, and operating margin is 2.4%. I would expect that's going to rise over time as well. Return equity 5-year average 9.3%. Return invested capital 3.9%. I would expect that to be now above 10% and also rising. P ratio 188.5. So the market is pricing in significant growth. Now, if it's on a low base, say the profit is like $1 billion, wouldn't be that much, $500 million. The chance the profit could increase threefold, fourfold over the next few years. So market cap is 62.6 million. I'm just going to have a quick look at the revenue growth. This is exactly what I want to look at or see. This is beautiful revenue growth, by the way. Beautiful. Exactly what you want to see. We'll get rid of the last 12 months. Although what you can do is the market is expecting some significant growth in the next 2 years. So next year, expecting $2.6 billion in revenue, and the year after, $3.3 billion in revenue. So the market is expecting the growth to continue. This is exactly what I'm looking for. Beautiful upward trend in revenue, and in a way, it is accelerating. The other thing I like to look at is you could look at gross margins. You just don't want to see gross margins dropping a lot. They are dropping, so that could be a slight red flag. But I do like to have a look at operating margins, and I would assume this has been rising. Oh, it's not. It's actually been dropping. It's a little bit of surprise, although it's risen the last few years. And I'm assuming company has become profitable. Yeah, so no profit until 2022, and the company actually doubled their profit in last year. So that is what can happen when a company reaches scale. They can quickly increase their profit, particularly if they're significantly increasing their revenue. You can see that revenues have increased 29.86% over the last 10 years and income at 38.59%. And if you have a look at, say, what's some of the expenses? Selling, general and administration expenses, that's been increasing at 29.66%, which is actually quicker than revenues. There you go. Did expect that. Okay, and what else? Let's have a look at the chart. Axon. I did not have a look at exactly what they do. You go to, say, the overview, and the company overview develops, manufactures, and sells conducted energy devices under the Taser brand. Tasers, yeah, operates through two segments, Taser and software and sensors. Okay, let's have a look at the chart. Okay, so the daily chart looks pretty good. No complaints about this. Nice breakout. Not much of a breakout. Share price wasn't doing much. In fact, I would have said the breakout was, yeah, little bit earlier than that. August 2022. If you have a look at the weekly chart, excuse me. Have a look at the weekly chart, and so they listed 2001. Share price did nothing, chart doing nothing until about 2013. And then since then, definitely the hallmarks of a high quality company. Really good buying in 2022. The share price actually did drop briefly below the 200-week moving average, and since then has remained well above it. So yeah, the share price has increased tenfold. Actually, has increased tenfold in the last 3 years. So Axon Enterprise doing really well. Would I buy some shares in this company right now? Probably not. Probably not, just because the share price has run up so much. But if they can continue to grow like they are right now, who knows how much further it has. But for me, the risk reward, it's not really balanced, or it's not really skewed towards reward. It's more skewed towards risk at these elevated prices and the PE ratio. But they could achieve what the market expects, particularly if they like double, triple, quadruple their profit over the next few years. They could definitely meet the market expectations. But just I do have a bit of a yeah. Anyway, 3 years ago was the time to buy it. Oh, JustJamesDean says no, Neppy, no, no, no. Limit size or limit position size to annual dividend of total portfolio. If total annual dividend from all shares is 10,000, then each position is 10,000. Okay, thank you for that clarification, JustJamesDean. So if total annual dividend for all shares, not from, I was just thinking one share, and I just didn't understand, but now I understand. So if your all dividends is 10,000, then each position is 10,000. Yes. Now I understand. Now I understand. Shamg33 says Aurizon and Aurizon looking interesting, increase in volume, but haven't quite broken out. I am following Aurizon quite closely because the share price of this company just keeps on going down. I do think there's potential value. It's not the highest quality company on the ASX. In fact, I wouldn't describe it as high quality at all. We'll go back to the daily chart here. Yeah, so we had a nice little bounce, but you can see the company has bounces, and as soon as it hits the 20-day moving average, which no, actually the 100-day moving average, which is the blue line, has acted as resistance for quite a while. You can see the share price has hit that moving average 1, 2, 3, 4, 5, 6, 7, 8, 9 times, and we have seen the share price pull back. So that is the resistance level for Aurizon. And the share price has pulled lower. Now, the share price around $3 right now, $2.99. Dividend yield 6.94%, P ratio 13.62. I don't think you're going to get much growth from Aurizon, but the question becomes, is there value in this company at these levels? So you might get a nice dividend yield. And if sentiment does shift, you might get some nice capital growth as well. I would not be absolutely shocked if you could get 100% gain from Aurizon if you time your purchase to perfection. And on top of that, you might get a nice dividend yield as well. Just on top of that. Anyway, and the reason I say that is if you go have a look at the weekly chart, share price high for Aurizon is about $6. Share price now $3, and the share price is close to where it was when they listed. So they listed back in 2010, looks like. I still remember when this listed. Yeah, I'm pretty sure they were spun out of the Queensland government. Anyway, so is there value this one? So I'm actually paying close attention to this one because I do think once sentiment does shift, you might get a nice capital return plus pretty nice dividend. Anyway, and the other one was a Origin. Was it Origin? I think it was Origin. Origin ORG. Oh, did you mean this one? Because you said increase in volume, but haven't quite broken out just yet. Actually, let's go back to and just have a look at the volume of Aurizon. So I always look at volume, but sometimes, yeah, well, the weekly volume is not that excellent. There's a big spike. Yeah, maybe a subtle increase in volume, not that much. What about Origin? So this one's a little bit different. I thought the share price of this one must have been in the downtrend, but this is, oh, okay, I must have been looking the wrong time. Okay, so the share price pulled back a fair bit on April. Okay, 7th of April, that makes sense. Share price not doing much, chart not doing much. It looked like there was a potential breakout a few days ago on the 13th of June. Share price has pulled back from there. Yeah, not my favorite chart at this point in time. In fact, I'd say this is more trendless than anything, maybe a very slight uptrend. And the volume, we haven't seen much or any big increase in volume. Thank you for that, Cham G33. Sensei 6011 says, Nappy, is your YouTube monetization turned on? No idea. I don't think so. Excuse me. I've been sick the last, not the, oh, a week ago, but it's still lingering a little bit. In Studio, it can be activated and linked to AdSense. Then you can turn on Super Thanks and also add the $2.99 a month channel membership. I might do that, Sensei. Sensei is like now a moderator on my channel. He should be. I did turn it on because if you go to these three dots, here he goes. Remove user as managing moderator. So Sensei is my managing moderator. You might notice a few comments from Sensei in regards to Kofi, buy me a hot chocolate. So if you do want to support this channel, buy me a hot chocolate, and there should be a link in the description of this video. So thank you for that, Sensei 6011. Stu Percy then apologizes for spelling my name wrong. That's okay. Not a question, more of a statement. That's okay. It's answer and reply. So I can reply to statements. I love investing in individual companies. One of the big questions is the share price fair value, cheap or expensive. Myself and assuming most of your listeners don't have a background in accounting, economics, or finance. Have I answered this before? Either I have answered this before or I did go through this question or this statement in the past and I had to think about it, but I can't remember if I answered it or just reply to it. This question can be quite daunting. So you look to professionals for help, well-educated people with years of experience in how to value a company. No need to name drop, but after reading their reports, the answer to this big question can vary from undervalued by a lot to overvalued by a lot. If they can't agree, no wonder people have turned to ETFs to invest and not have to deal with the stress. I would advocate that people invest in ETFs if they don't want to put the time and effort into it. I'd say, yeah, ETFs is the way to go. I prefer to put my time and effort into it because I think my returns can significantly outperform ETFs. That's the whole reason. And if you compare a 20% return, which is my aim, to what you can get from ETFs over lifetime, that's significant difference. That is a significant difference. That's why I think there is some validity, some strength to trying to learn how to invest in individual companies. If you have a look at the richest people in the world, they don't become rich by buying ETFs. They become rich by putting all their money into individual companies. So if you just have a look at a CAGR, say CAGR, and have a look, CAGR calculation. We'll do a CAGR calculator. And hopefully this is right, CAGR calculator. So starting value. And what we'll do is we'll just start off with $100,000. Why not? $100,000. Number of, oh, this is, oh, no, I don't want this one. I want where I can put a CAGR, where I can put the percentage. Uh, yeah, I don't know how to do this. I'm pretty sure there's been a, yeah, here, maybe, no, these are, here, oh, this is the one. So say you're getting 20% return, number of periods, 30 years, initial value, $100,000. So you end up with, is that No, that's 1 million. Sorry, that's 1 million. So say, actually, we'll start off with 10. No, we'll start off with 8. So say you buy ETFs, you get 8% return per year over 30 years. You start off with $100,000 and that's it. You don't put any more money into it. You end up with $1 million. That's pretty good. Going from $100,000 to $1 million in 30 years at 8% CAGR. So what happens if you are a stock picker and you do really well, say Warren Buffett? And in fact, a lot of the professional stock pickers, that's their aim, 20%. And I think we can all achieve 20%. I'm definitely doing it. So I think we can all do it. And when I say definitely, don't mean since I started investing, but over the last few years, definitely getting way more than 20%. Definitely getting way more than market. That's the most important thing. But if you get 20% CAGR over 30 years, that $100,000 turns into 23.7 million. What would you prefer? $1 million, $23.7 million. There's a big difference. And that's the attractiveness of individual stock picking because you can definitely achieve 20% returns. And I think it's much harder to get those sort of returns, way harder to get those sort of returns if you're just putting your money into ETFs. So if you do put your time and effort into investing, your end returns are going to be significantly higher. And I really want to just say there are some experts who say you can't beat the market. They will say this. You cannot beat the market, so just put your money into ETFs. That's wrong. If you put time and effort, you can definitely beat the market. Anyway, I also say in regards to this particular statement from Stu Percy, I almost never look at the valuations of experts because the whole reason I don't do that is sometimes you just don't know how they value a company. And a really good story was someone trying to value Nvidia, was it 2 or 3 years ago? And they used a DCF, which DCFs, I think, can be really difficult and can really constrain you from buying good quality companies because you tend to be quite conservative with DCFs. And a lot of the big companies, growing companies, they can significantly beat any expectations. And this happened with someone doing a DCF on Nvidia a few years ago. Their assumptions were way out. Their assumptions were way out. In fact, they actually put all the numbers of the cash flow of Nvidia over the next 10 years. And in 2033 or 32, they said the cash flow of Nvidia was going to be a certain amount. And with 1 year, they were wrong. And when I say 1 year, they were wrong, Nvidia's cash flow in 2023 was greater than this person's expected cash flow of Nvidia in 2032. And during this whole post, they were saying, Nvidia is so expensive, it's way overvalued. And this is the reasons why. This is the reasons why. They just not understand that Nvidia was going through a growth spurt. And so they got that significantly wrong. And all they had to do, was read some of Nvidia's statements, their commentary, and they were pointing out the significant growth ahead for Nvidia. They were seeing that growth in their statements. What's his name? Jensen, whatever his name is. He was mentioning they were expecting significant growth, and they delivered on that significant growth. But a lot of people just ignore that, and they just said, "Oh, Nvidia is so expensive," and it's actually looking way cheaper now than it is or was back then. Yet the share price is significantly higher. It's because of the significant growth. So I never look at any valuations that any experts do because how they get these numbers, sometimes you just don't know. Sometimes how they get it. And it's bad. You could have two people look at the same company, different assumptions, and they can get wildly different valuations, as Stu Percy mentioned. So I completely ignore valuations from companies. I prefer to do my own. That's why I've got someone to blame if I get it wrong or if it's wrong. Dan Bag says, hi, Neppy, curious with your trading positions that earn dividends. Do you have it automatically purchase more shares in the company that paid the dividends, or do you take it as cash and redeploy it in other opportunities? I have never, ever, ever, ever done share purchase plan, the dividend share purchase plan. Never done that. I will rather take the cash and redeploy it. So that's exactly what I do. Just redeploy it in other opportunities. Yes. Because typically my trading positions may not be longer term. So I prefer to either redeploy that cash, or if I do see a breakout in the company's share price, that's when I might add to the position. So I don't add to my position through dividends. So thank you for that, Dan Bag. Happy now. Thanks for getting me through a cold and dark Sunday night with another video. I read somewhere in my early reading on my investing journey that the best experts, pros, trade at 66% success rate. Outside of a few dog stocks off the top of my head, some days I swear your success rate at trading is more like 90% plus amazing. No, outside of it. Um, my success rate, I did this maybe a year ago, is about 70%. So I do aim for 60%. So 70%, a little bit higher. So I do aim for 60%. And the reason you can do really well with a 60% success rate is simply by running with your winners and getting rid of your losers. So that's why I have rules. And if a share price does drop, like 10% from when I bought, sell out. So at the end of the financial year, what you'll see is a lot of your best gainers are up a lot. They're up significantly, but your losers are only down a small amount. It adds up, which is why a lot of investors, what they tend to do is they sell out their winners and maintain a holding on the losers. And that's the wrong philosophy by far, because eventually your portfolio is going to be full of losers. What I do is try to have my portfolio full of winners. For instance, if you have a look at my trading portfolio right now, so this is in list of or rank of how long I've held it. Stealth Group, massive winner. It's up, was that 6-fold since I bought? Shape Australia, winner. Some of these I probably should have bought more. So add it to my winners. Genus Plus, winner. Beautiful charts. Superloop, winner. Catapult, winner. Solvar, it's doing okay, but still going up. QBE. Yeah, so if we keep going down, you'll see a lot of companies I've held for a while. They're in my winner space because share price or the chart looks beautiful. You won't see many losers at the top of my list. All my losers will be near the bottom, and if they keep on losing, I'll sell. Keep on losing, and I will sell. Like maybe Ramsay Health. Ramsay Health. Ramsay Health. It's done to turn. Maybe it's bouncing now. Maybe it's bouncing. Anyway, so yeah, I think my success rate would be more like 70%. A DSHW5CC says Cosol sell-off seems unusual. Lots of selling for no apparent reason has bounced pretty hard so far. I had a look at this last night, by the way, Cosol. And yes, the bounce has been pretty awesome. I sort of expected a bounce, and it's happened, but I'm changing my philosophy, and I'm not going to be trading these situations anymore. Where I do expect a bounce and the share price bounce, I'm going to be trading winners. And the reason I'm doing that, I sold out of two positions last week, Satire and MVF, 10% gains on a little bounce. And the reason I'm doing this is what I realized was in these situations, I'm paying way more attention, abnormally way more attention than I should be on these particular trades. Even during the day, I go, oh, share price is up, or maybe I should trade it. Maybe I should sell right now. And I don't want to do that. I want to own positions for a long time, as long as possible. And these were never long-term positions. These were just waiting for a bounce, and they could go ugly and turn against me. Because you can see with Monash, you could have tried to bounce trade this one. You could have actually done fairly well when the share price dropped a lot on the 11th of April. But as soon as the share price hit the 25-day moving average, I decided I'm going to sell. So that's what happened with Monash and Seta. Share price hit the 25-day moving average. I went, I'm going to take my profits with both of these trades. Now, the share price of both companies could go on runs, could move in uptrends, and then I might take a longer term position if I see the share price moving into an uptrend. So with Cosol, even though I did expect a bounce, I went, no, I'm not going to trade that bounce. And it was really oversold. So I can definitely say why this bounced. But again, I'm not sure how much further bounce is going to go from here. Share price has hit the 25-day moving average. We have seen a little bit of selling coming in, but not a lot. And the volume has decreased, which tells me this little bounce is running out of puff. Okay, oh, here we go. Sensei 6011. If you viewers, subscribers, people in the comments section enjoy and make money for yourself from these Neppy vlogs, please do consider buying Neppy a virtual cup of coffee, hot chocolate, on his Ko-fi page as a thank you. The direct web link is listed in the description box above. Minimal cost is $2, but you can give more than $2 if you can afford it. Also, 3 thumbs up. So thank you for that, Sensei 6011. Now, you don't have to. I'm not strapped for cash, anything like that. But yeah, I do these videos for free, I suppose. I've been asked quite a few times from different businesses if they can sponsor the video, and yeah, I'm just not into that sort of thing. Anyway, so if you want to, Yeah, don't mind. I don't mind it. So thank you for that, Sensei. And Sensei is going out his way to do this. Really, he doesn't have to, or she doesn't have to. But I just want to say thank you for Sensei because he does send me, or she sends me quite a few emails, and I do think I'm I sometimes am being a little bit slack, not replying. And so Sensei should probably manage everything except my videos. I prefer just to manage my videos myself, like the editing, that sort of thing. Matthew WH2941. By the way, if anyone else wants to be a moderator on my like comment section, that sort of thing, feel free to send me an email. Matthew H2941. Surprised? Oh, this is just a comment. I did laugh at this one. Surprised the ASX didn't break this morning with the removal of the staggered starts. Yes, yes, I like that. A little bit surprised and that sort of thing when the ASX changes. Sometimes it goes pear-shaped. Anyway, Trader Hooper. ELS had a non-price sensitive announcement today, but snuck in a comment about the cash position. Bodes well for a great quarterly next month. End of the day, down 2 cents. No real market reaction. Let's have a look. I missed this one. I missed this one. I love this sort of insight or this sort of comment because I sometimes will miss announcements that are not market price sensitive. So was it the 23rd of 6? Elsight shows supply chain resilience with accelerated delivery. Yeah, not market price sensitive. So I would have missed this one. And I love when I see comments like this. Talking about the cash position surged. Oh, I like the sound of that. To 6.4 million from 883 as in the last 4C, driven by high visibility contracts and favorable payable payment terms. So the operating cash flow for Elsight should be quite significant in this particular quarter. So you could anticipate a really good quarter from the company and get ahead of the crowd maybe. Let's have a look at the chart. I noticed the share price did increase 9% on Friday. So let's have a look at the chart for Elsight. I have a feeling this chart might be pretty good. Oh, wow, that's way better than pretty good. So the market has, I think, has discovered this company and the share price has really taken off. Really taken off. And the share price did pull back a little bit, but we haven't seen any significant pullback for Elsight. Look at the volume. So this is I wish I caught this a little bit earlier. So for me, the breakout for Elsight would have been, if you put a line there, that's the breakout. That line there. And you can see the share price got to this line and went sideways right on the line for 1, 2, 3, 4, 5, 6 trading days. And we didn't see share price going lower and then the share price started to go up. That is probably the time to have bought Elsight back in late May when the share price was 60 cents. It's doubled since then. Well, the chart looks better than I thought, but has the share price got away from us? That's probably the big question right now. Has a market cap of 274.4 million, but I think the quarter is going to be really good for Elsight. Thank you for that, Trader Hooper. VB Ed says, I had an interesting conversation with a guy who manages a high profile car yard here in Perth. He stated to me that sales in his industry at the moment are down 50%. It is very depressing retail environment right now in the car retailing industry. This must be a sign that Australia is technically in a recession right now. There is always a 3 to 6 month lag between when a recession starts and when it becomes official. I feel it would be wise to get out of consumer discretionary stocks right now. And we have seen a few consumer discretionary stocks release really bad trading updates. Maybe not really bad, but negative trading updates. And what is really interesting about this is if you have a look at some of the car dealership companies on the ASX, so we already know that Eagers Automotive is doing or was doing really well. So really nice looking chart. And that's maybe to do with Baidu, I think, their relationship with Baidu. But there's another couple. Actually, we won't start with that. Peter Warren Automotive Holdings. So the chart has been a downtrend, but maybe it's found a bottom. But I was really intrigued to see automotive or auto sports group share price is trying to move into an uptrend. And I'm just wondering why. I'm wondering why that is happening because both Autosports and Peter Warren have released negative trading updates in the past 6 months or so. And I think VBED is probably right. I wouldn't be shocked to see a lot of people foregoing or I wouldn't say canceling, but postponing, that's the word, postponing any large purchases like cars maybe massive TVs, that sort of thing, because there's still a bit of uncertainty out there. So I do agree with VB Ed, and he has some proof here, me in Perth, that there is a bit of depressed environment in that area. So it's going to be really interesting to see how these car dealership companies have performed in the last half year when they release the results in August. Then maybe they'll release some negative trading updates in the next few weeks. Anyway, I did notice the ASG Autosports Group. I noticed that chart sort of breaking out, and I was like, oh, no, 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 not for me. Again, there's a lot of opportunities on the market. Uh, Trung Nguyen, Vietnamese, I believe. Hi, Neppy. I'd like to ask how XRF aligns with your investment criteria for small cap stocks. Aligns perfectly. Aligns perfectly. So when it comes to small cap stocks, I do prefer companies that are growing. I do prefer companies that are profitable, cash flow positive. Sometimes will buy a company that is not profitable or cash flow positive if I think the runway to that inflection point is near and they will achieve it. A bit of risk in these sort of companies because they're small. XRF is a little bit cyclical because they are aligned with the mining industry. And Stu Percy says he's a holder. Their metrics are pretty good and they seem to be growing. I'll keep holding unless that changes. Now, I have held this in the past. This was a trading stock for me. And I have thought, oh, maybe I should have held it for the longer term. So at the moment, I'm not trading it. So beautiful uptrend. I held it for a long time, by the way. And then I decided to sell when the share price, so after this peak, the share price didn't rally out and I decided to sell at that point. The chart looks good again. If we have a look at some of the metrics of XRF, I do like these metrics. I wouldn't define XRF as high quality just yet, but I do think it has a potential. So revenue growth between 10 and 20%. Earnings per share growth between 12 and 27%. So nice growth. Dividend yield is 2.1%. Payout ratio 57.5%. I probably would prefer that to be a little bit lower, to be honest. I would prefer this company to try to, particularly with their return on equity, 15.7%, return invested capital 15.2%. I'm just wondering whether the company would be better off in the long term reinvesting their cash flow or their profits back into the business. Now, that's up to the management. And management maybe they've gone through that and thought, yeah, maybe we'll give half our money back to shareholders as dividends. P ratio currently 26, maybe slightly on the high side. And one of the reasons probably might have been a little bit, maybe a very slight red flag. If I remember, there was a trading update or something. Oh yeah, quarterly trading report. Wasn't that extremely positive, this one. Yeah, revenue was down 9%. Profit before tax up 5%. That was for the quarter. Year to date, revenue actually down 3%, but profit before tax up 10%. So it wasn't actually a really good start to financial year. So I'm going to be interested to see how they have performed in the last, when they release results in August. But this company definitely aligns with what I look for. Growth, that sort of thing. Definitely growth. It's one of the things I look for. Revenue growth, earnings per share growth, profitability. So yeah, so this is definitely a company I could see myself holding for the long term eventually. Sensei 6011 says, thoughts on Greatland Resources, GGP ASX code. I've never heard of this company. There you go. There are over 2,000 companies on the ASX, or maybe it's not 2,000 anymore. Maybe it's less than 2,000 because companies keep on leaving and we don't have many IPOs. Share price of this company is $7.19. Okay. Why have I never heard of this? Oh, it's a recent listing. That's probably why. They listed on the 23rd. That's why I've never heard of this company. Okay, so great. The share price is really high. I'm wondering either they have a really low amount of shares on issue or this company's pretty big. The way you can find that is just put it into Mark Index. Market cap is 4.82 billion. So this company is pretty big. So I would assume this company is in production. Okay, so typically when I do look at a new listing, I prefer to look at the prospectus for Greatland, what this company's called again, Greatland Resources. Their prospectus is 572 pages. Now, I'm going to actually try to open this up via market index because it might be quicker. Where is it? There it is. We'll see how long this takes to open. Look at that, beautifully quick. and ComSec still opening. Okay, so I I love prospectuses for many reasons. One of the reasons I love prospectuses is because you get a lot of information. So if there is an index here somewhere, timetable, where's my index? I love indexes. Here we go. So one of the reasons I love prospectuses is not only you get an overview of the company, you get an overview of the sector. So industry overview, I love that. So overview of Greatland, that goes for like 50 pages, lots of information. The industry overview goes for like 12 pages. Something to do with UK scheme and reorganization. So is this a UK company? Details of the offer, proposed admission, financial information, which is also like that. There also should be a risk session, risk set section. Here it is, risk factors, key people, which is pretty important, directors, senior management, rights and liabilities, additional information, and then, geez, independent technical assessment report is 250 pages long. Hands up, who's going to read that? Not me, not me at all. All right, so let's have a look at the overview of the company, which is found on page 29. Page 29. Which page are we on now? So it's a public company that was incorporated in England and Wales in 2005, and its shares were admitted to trading on AIM in 2006. Has a market cap of approximately 1.557 million pounds, $3.224 million Australian dollars. Is Australian public company incorporated on 30th of May 2023. Oh, Newmont owns some shares. There you go. Newmont owns 20.19% of GGP shares. Oh, that's interesting. I'm telling you, you get lots of information in prospectuses. So when a company, if a company has been on the ASX for less than 2 years, I more than likely will have a look at the prospectus at one point. Where is the what page am I on? Oh, still got a long way to go. I should just what I should do is go like this. There we go. I should have done that from the start. Overview of the company. They'll talk about the company here. History and group structure. So they're paying a lot of money out to probably holders or something. GGP discovered the world-class Havrian gold copper deposit in 2018, a brownfield world-class underground gold copper development project located 45 kilometers to the east of Telfer. I know where Telfer is. Gold copper mine in the Patterson province of Western Australia. The reason I know where Telfer is because I forecast for the Telfer airport. In fact, a lot of the airports we forecast in West Australia are mining airports, and some of the mining airports are very close to each other, which is frustrating because you're doing two separate forecasts for airports that might be like 10 kilometers apart, or maybe not that short, but it does become a little bit ridiculous. Okay, history. I love history timelines. Acquisition of Havrian exploration license in 2016, et cetera, et cetera. Going through the whole history, corporate structure, beautiful overview of the assets. There it is. So you go through this if you really, really want to. Resource and ore reserve, leadership. See if I know any names here. More than likely I don't. Yasmin Broughton. These are probably the more important people, in my opinion. Monique Connolly, Chief Financial Officer. She looks young. Sean Day, he looks pretty young as well, although he hasn't much hair. In fact, they all look young. Maybe it's just me. Maybe I'm getting old and everyone looks young these days. Okay, and yeah, so go through this. So at this point in time, I have no opinion of this company. Talking about Telfer, snapshot of Telfer. Okay, what else? Financials. So one thing I do like to do is have a look at financials, but the other thing you could do, instead of going through the prospectus, you can just have a look at their accounts. So the most recent accounts, 31st of December 2024. So they should release accounts as well, separate from the prospectus. So you can just see how they have performed in the last year, or the last half year anyway. So we go to the cash flow or revenue, profit loss statement. So revenue of 8.3 million pounds. That seems like a little low. Gross profit of 2 points. That must be That seems really low. I don't know about that. So the income tax benefit. They have $491 million of equity, share premium, 510 million, and cash flow. Operating cash flow negative, and ooh, they made an acquisition of Telfa Havarion, $130 million. Anyhow, so in this sort of company, what I usually do, because I just listed, is I just put it into watch list, and that's it, unless the company releases a profit upgrade. So you can't sell anything from the chart just yet because it hasn't been on the ASX all too long. So there's no technicals. Look at that. There's no technicals at all for Greatland Resources. So what I do is, and I haven't done it yet, is I'll put this in my IPO watch list. Yes, I have a watch list called IPO. And whenever I do a deeper dive into a company, I take it out of my IPO watch list and put it into another watch list. And that could be within the next 6 months. It could be a year from now. It could be 2 years from now. So Sensei, I have no thoughts on that company right now. Zero thoughts. I've already answered Blacktop. Trader Hooper says, I also saw GBM Resources announcement, but didn't open it because it was no of interest to me. I've heard of Ian Middlemas. I'm thinking I need to start a list of people with notable reputations, but perhaps that would be of greatest value for stocks under $100 million. Don't know. Still pondering. It's a really good thought. I thought about this in the past. I've thought about doing this in the past, just having a list of people I should be following, like management, because a lot of times, particularly if they can grow a company from fairly small to big, and not only like the CEO, I'm talking about all the other management. So, for instance, Northern Star, a lot of the initial management of Northern Star are now in other companies. So, just having a list of names could be really helpful. So, very happy that Trader Hooper actually mentions this because this is something I have thought of doing. Oh, Mace552 says, I think I've already answered this in a way. Do you regret saying that CBA was overvalued and not taking a position when it was $150 now that you look at the share price today? And no, I think I already answered no, I don't have regrets. But do you regret saying that CBA was overvalued? No, because it's still overvalued. Just because the share price goes up doesn't mean it's not overvalued anymore. In fact, because the share price has gone up and nothing has changed with the company. It was overvalued back then and the share price has gone up. It's even more overvalued at these levels. And I have no regrets not taking a position because, again, risk reward. What's the reward you're going to get for a company that has very little growth, that is trading on a P ratio of over 30? What's the reward? In fact, you could say this might sound pretty bad. You could say this is more of a Ponzi scheme right now, that you're hoping that people are going to buy shares in this company at a higher price than it is right now. And I would not do that sort of thing. You're just hoping and wishing that people are willing to pay a higher price. And I just think the risk right now with a company that is way overvalued, and it's historically overvalued. It's not a little bit overvalued, it's historically overvalued. It might keep going up, but there's just that risk there. And the reward is not going to be that great. You're not going to get the double bagger from this one. You might get a 20% return, but there's still that risk. So for me, it's all about weighing up the risk and rewards. And for CBA, because it is so overvalued on the back of compared to historical ranges, how much further can it run? Because the company is not going to grow to get up to where it should be valued, like fair value. It needs to grow. For the share price to go sideways, CBA needs to grow. And I'll be honest with you, CBA share price could go sideways for the next 10 years and still be overvalued. That's how overvalued it is right now. But people are still willing to buy it. Maybe it's just because the chart looks so good. It could be just momentum. It could be just index funds just buying blindly. And again, why would you do that? Share price did drop a fair bit on Friday. So yeah, it's just for me, there's just too much risk when it comes to companies that are significantly overvalued, like CBA. But good luck if you're owning CBA or you just bought CBA. Good luck. Maybe the share price will keep on going up to a P ratio of 40. And then I'll keep on saying it's significantly overvalued and you have to beware because history shows us when a company is significantly overvalued, particularly a company that is not growing, it's in a bubble. And when that bubble bursts, things fall flat. VBAD says, supply network is now well down from its recent high. How far would it need to drop to be a buy? Okay, so I do own Supply Network, a company I've been following for, I followed forever. And I was going, I'll just wait for a pullback and I'll buy. Okay, so this is the daily chart, beautiful daily chart, weekly chart, beautiful weekly chart. You don't see much pullback. So we have seen a pullback. In fact, a few weeks ago, share price of Supply Network dropped 9% in a week, which is actually quite rare. Share price got to $42 and has pulled back slightly. Or if it, that's better. Has pulled back slightly, went from 42 back down to $36. Okay, so I do own shares in Supply Network. And what I'm going to do now, a slight change in my investing philosophy is when I see a high quality company, and I do consider Supply Network now to be a high quality company. When I see a high quality company share price drop to I wouldn't say a fair value. And if you have a look at the weekly chart and put in the 200-week moving average, so I think share Supply Network would have to drop a fair bit just based off this. But also valuation, the P ratio of Supply Network is around 40, which is historically at a high level, 41.2. It's historically a high level. I do think what's happened is the perception of Supply Network has changed over the past 5 years from, oh, it's a small company growing nicely, to a perception of this is a high quality company that you want to own for the long term. Nicely growing, really good growth. You've had a look at the revenue and earnings per share growth, brilliant growth over the last 3, 5, 10 years. Return equity, return invested capital, margins, all nice. It's just the valuation. So you could do a reverse DCF and I used to use Guru Focus to do my reverse DCFs. You could do I want to see if ChatGPT could do this. I'm pretty sure ChatGPT can do this. Let me just confirm. Reverse DCF for supply network. And then I should confirm whether this what ChatGPT is actually doing, what it's doing is doing right. Uh, it's saying, assuming I'm referring to Supply Network as a company. Wait, calculate for me. I wonder if it's going to ask me for some options. Oh, I was going to say the assumptions. Yeah. So discount rate 8%, terminal growth rate 2.5%, probably a little bit conservative potentially. Projection period 10 years. So it's saying, and I should actually look at this calculations, it looks complicated. Using numerical methods or financing modeling tools, the implied annual free cash flow growth rate that satisfies this equation is approximately 20% over the next 10 years. And implied for FCF growth rate of 20% suggests that the market expects Supply Network to significantly increase its free cash flow annually over the next decade, which it could do because if you have a look at the growth in a Supply Network, just revenue and earnings per share growth, it's been growing at more than 20% per year over the last 5 years. So it could definitely achieve that. So I do think right now, Supply Network is definitely not cheap, not good value. I wouldn't say it's fair value. I'd probably say it is slightly overvalued, but if it continues to grow the way it has been, yeah, I wouldn't say it's necessarily expensive either. But how much further would it have to fall? If I personally, if I saw the share price drop, say if I saw the share price, definitely if it dropped 50% from here, that would be a no-brainer for me. 50%. But that's a fair big drop. I don't think it's going to do that unless we see significant weakness in the market. So because I'm holding this, I probably would wait for that sort of setting of a drop before I add to my position. So be a little bit more conservative if I want to add to my position. That's the way I would play it. But if the company can achieve that sort of growth, which I think it can, any sort of pullback towards $30 would be probably nice value. Don't know why YouTube Studio does this. It keeps going down. Ben Hutchinson says one idea for a potential offline video would be a reaction. Oh yeah, okay. So Ben Hutchinson just mentions that Bill Potter's top financial 26 picks were released, and that would be a nice little banked video. And we had a second someone saying this as well. So more than likely, I'm going to do it if I can find it. Maybe I did not. Anyway, two people of you mentioned this Bill Potter's financial or top financial year 26 picks as a video I can do. And yes, I will do that. Trung Nian says, is it a good time to do a 30 or 13-month portfolio update, Nappy? Yes, it is a good day. And I was thinking I should do this at the start of the financial year because we have one more training day to go before the start of the financing year. I'm just wondering if I should release that video in September and October. That's what I've got to decide right now. But definitely going to do this. Neppy's top 20 holdings. It has changed, but not as much as you might think. Definitely some of my training positions have changed, but some of my non-trading positions have not changed at all. Still holding them. Still holding for the long term. That's the whole point. Holding for them for the long term. Trader Hooper says, I like your comments there being so many opportunities in the market and we can't get them all, so we shouldn't regret missing some. So true. Plus, we also have strengths and weaknesses, so need to trade to our own strengths. A good trading stock for one person may not be good for another. I've seen so many people have losing trades in stocks where others have made great gains. This is a very important point. I think the ability to understand yourself is not only important in investing, it's important in life. It's important in life. And I think once you really understand yourself, you can just lead a much happier life. Don't lead a life to how you think other people expect you to lead. Lead your life how you want to lead it. Unless it's really hurting other people. Unless you're a serial killer, then that's probably not the best thing to do. But anyway, find your strengths and weaknesses. Find at what you're really good at. And the other thing is find what you like doing. So I actually do like trading. I really enjoy trading. And I, in fact, might even enjoy trading more than finding new companies. So there's a chance that in the future, if I even enjoy trading even more, that is what I'm going to pivot to because I'm doing fairly well with how I'm trading as well. And maybe there's some truth to the fact that if you enjoy doing something, more than likely you'll be better at doing that as well. So Trader Hooper is very wise, a very wise person. Find your own strengths. And that is why another reason why I hate experts who say there's only one way to trade or invest. Like, what's his name? Phil Town. I used to listen to his podcast all the time. And then one podcast he mentioned, there's only one way to invest. That's my way. He's a disciple of Warren Buffett. This is the only way everyone should invest. And that's the last time I listened to him. And even I've heard people like some of the experts in Australia on Ausbiz the Core, some other people saying, this is the way you should trade. This is the way everyone should invest. And trading doesn't work. Technical analysis doesn't work. And I don't like that because just the way they invest may not work for other people because we all have different strengths and weaknesses. So just find what you're good at and lean into that. Okay, Sensei, thoughts on Sezzle, which was on the ASX, now is on the Nasdaq. Bought a parcel 2 years ago for $275, and today it's $160. Wow, good work. Didn't realize Sezzle was doing so well. Sezzle doing so well. Let's have a look at the chart. Whoa, look at that chart. That's a weekly chart. It's gone bananas. In fact, it's gone bananas just the last since the 7th of April. Share price has gone up 8-fold almost. And must be on the back of some good news. Share price broke out on the 8th of May. In fact, if you have a look at what I like to look at, the two moving averages, I probably wouldn't be chasing this right now. Then what's the market cap? Must be huge. At $5.51 billion. Says the P ratio is only 55. There you go. But wow, that's an impressive rise from Sezzle. Maybe they made the right move going listing on the Nasdaq. And that's all I'm going to say. Actually, Sezzle. So sometimes what I do is Sezzle investor relations. I won't have a look at Fiscal AI. I do on occasion go to the investor relation page on companies, and they will sometimes have the most recent announcements, quarterly earnings. Here we go. They had a presentation, a form. First quarter, this was May 7th. So this was just over or just under 2 months ago. And that was the day the share price broke out, it looks like. Yep, that was the day the share price broke out. So there must have been something really good in this. Revenue growth 123.3%, net income 36.2 million. Income, this was an absolute stunning upgrade. So prior, this is financial year 25 guidance. Prior was income of 80.4 million. Then they updated that to 220 million. So a 50% increase in guidance for profit. Net income per diluted share, 221 to 325. Product launches, 5 and 5. Sezzle balance. Wow. 6-for-1 stock split. Yeah, they say driving shareholder value, but that's not really. That's misleading. Stock split is not. Uh, it's tricky to say this. Technically it's not changing shareholder value, but there is this perception that the share price of a company goes through a stock split. The company's now cheaper. So I know Nvidia's done this. Some of the big tech companies have done this. They've done a stock split, and the perception among many retail investors, it's now cheap, but it's not. The valuation of the company hasn't changed, but they just see the share price down much lower, and they think, oh, it's cheaper. I can buy some shares now. So this is a little bit misleading, but I can definitely see why they say this, that if they do a stock split, it's driving shareholder value, because share price sometimes can rally on that because of this misconceived perception that the company is cheaper. A share price does not mean anything about the valuation of a company. Again, share price does not mean anything about a valuation of a company. Share price of a company can be $1 and it can be ridiculously expensive, or it can be ridiculously cheap. Context matters. Anyway, what can I say, Sensei? What's there to say about that? And again, that has moved off where I was. What can I say? That was a pretty good. That was a really good update. Massive. That's exactly what I'm looking for on the ASX, but I missed this one. Would I have, by the way, if I did catch this, would I have traded this? Yes. This was a breakout. This is a stunning breakout. If I did catch this one, I would have. I just find it hard to find all these sort of setups on the US. I was thinking of doing this on the Nasdaq and the New York Stock Exchange, but I found it really hard to follow. So I just decided just to stick to the USA. But should have wished Sezzle was still on the ASX, because I would have picked up on this. And this is a beautiful breakout. Beautiful breakout. By the way, you could have doubled your money just on this breakout. Anyway, good work. Good work. Good work. Sensei. Oliver mentioned Bub has a golden cross on the daily. Thoughts? Yes, we had Bubs pop up recently, and I don't mind this chart. In fact, if you just zoom out, the chart even looks better. Share price in a downtrend from 2022 through to 2024. Share price then sort of gone on a consolidation period, a nice long consolidation period, sort of trading in a range between 10 cents, maybe 15, 16 cents. And we've started to see share price turn up. So I actually do like this chart. Not trading it right now, but I'm putting it onto my watch list. I'm writing it down right now because I forgot about it. So thank you for that. Oliver mentioned, because I forgot about that. Someone mentioned it a few weeks ago and it looked good then. AU5657s, do you like Hansen Technologies? Seem so undervalued. Let's have a look at Hansen Technologies. I have liked this company on and off over the past 10 or so years. Sometimes I like it, sometimes I go, not for me. So let's have a look at Hansen Technologies, a fairly rough look, a quick rough look. Exactly what I do with all companies. Revenue growth. Over the last 5 years, only 5 to 6.7%. I'd like that to be a little bit higher. Over the last 10 years, 14.5%. So there is a chance that revenue has deaccelerated the last few years. I'm not sure why. I'd like to discover why. Earnings per share has gone backwards over the last 3, 5, 10 years. Why is that? could be just a one-off. We'll have a look in the financials in a second. That could be just because of one-off in the last year. Margins, gross margins 27.7%, operating margins 7.1%. I'd like both of those to be a little bit higher. I thought this was a software company. Develops, integrates, and supports billing system software for the energy and utilities. So why are their margins not higher than that? I would expect a software company to be a little bit higher. So for those who know more about Hansen, why are the margins fairly low? I would expect a software company to have much bigger margins than gross of 27.7% and operating at 7.1%. Return equity 13%, 5-year average. Return invested capital 9.2%. That's sort of borderline, so borderline high quality. P/E ratio 300.2. Okay, so we already know there was a one-off in the last year's earnings because I don't think this company has a true P/E ratio of 302. If you have a look at some of the other metrics, valuation metrics, price to book 2.9, price to free cash flow 28, EV to gross profit 10.4. So let's have a look at that now. Let's have a look at revenue. And what I'll do is I'll get rid of the last 12 months. Revenue is still growing. I have no complaints about that, but the revenue growth definitely between 2015 and 2020 was way more impressive than the last 5 years, but it could be just a slow period. But we have seen possibly the revenue starting to grow again in the last year, gone from a 311 to 353. So it's gone up 10%. But if we have a look at income, you'll probably notice a big drop, or maybe even, yeah. So income went or halved from 42 million to 21 million. And why is that? So what is there a one-off? Restructuring charges, that's a one-off, 6.2 million. And it looks like margins have come down as well. And what I say that is if you have a look at gross margins and operating margins, oh, it's gone. Oh, there we go. Yeah, if you have a look at margins, they've both been pulling back the last few years, and last year it did. Both margins dropped a lot. Why is that? Why is that? I'd like to answer that because if margins start going up again, and the company can increasing their revenue, and we don't have the one-offs, this company could get to a profit next year of say $50 million, maybe even more than that. In fact, let's have a look at the last half year. So, in fact, the last half year they had a profit of 0.1 million. So that could be a little bit disturbing. I wonder if that's a one-off. Let's have a look. Yeah, there was a one-off for 6.5 million. In fact, the last 2.5 years, they had one-offs of about $10 million. So that has put a bit of this restructuring charges. So that has put a bit of a what do you call it, a false narrative when it comes to profit of this company. I don't think the profit will be 50 million, but in my opinion, true profit of this company would be about $50 million. And that would mean with the markup of say 984 million, P ratio of this company is below 20. So I wouldn't say it's necessarily cheap. If I thought the profit might be as high as like 100 million, definitely cheap. So somewhere in between 50 and $100 million, I would consider this company cheap. But don't have a look at the P/E ratio. Don't have a look at the decreasing earnings per share. It's just because there's been some restructuring charges, some one-offs. Anyway, back to the answer. Seems so undervalued. I wouldn't go that far. Personally, I wouldn't go that far with Hansen Technologies. But it is promising that the revenue has started to grow again in the last half year or the last year. And the chart for Hansen Technologies. Let's have a look at this one. So have a look at the weekly chart. And the main thing about this weekly chart is over time, over the last 15 years, the share price has gone up a fair bit. It's gone from 50 cents to $4.85. So if you held it for the long term, yeah, you've done well. But there are periods when the share price does nothing. In fact, the share price went sideways between 2016 and 2020, and it's going sideways again between 2021 and 2025. And then when the share price goes on a run, it went on a run for a very short period of time. I think this could be sort of on the precipice of being high quality. And if we do start seeing some nice growth, increasing margins, I think this company could be looking okay. Yeah, looking good. We'll say looking good. Trade Hooper says, seems like a few engineering and construction companies have done very well over the past year. Not a sector that I normally follow, but just a few names that have cropped up on here. GR Engineering, GNG. Oh, this chart looks good. GR Engineering. That chart looks good. This is the weekly chart. Genus Plus. Oh, by the way, what I'll do is I'll go to the daily chart because most of these companies I would focus on the daily chart. So GR Engineering, chart looks good. Genus Plus, chart looks good. I know this one because I'm trading this one. Monodelphis, this is another really good looking chart. Some of these I probably wouldn't chase right now. I think it's maybe touched too late. The chart looks pretty good. What else do we have here? A Shape Australia. Well, we know this one looks really good. Trading this one. And the last two are SRG&T, which I've shown you. In fact, I do like these charts as well. And these are sort of two companies that I'm just contemplating maybe trading these two. Maybe. Yes, maybe. So yeah, Trader Cooper is right. All have rather nice one-year charts. Could be toppy now, but a very nice year for them. Yes, there is a chance they might be toppy. And all it takes is one little bit of a negative trading update and the share price of all companies could drop. JustJamesDean says something very interesting. CBA goes up each time mining goes down. If CBA is overvalued, load up on mining and wait for CBA bubble to pop. This is really interesting because on Friday, CBA share price dropped a lot, yet mining companies went up. And I am wondering if CBA bubble does pop, that could be meaning a lot of funds are going from the banks into mining. So that could be the time to load up on mining. So I actually do agree with JustJamesDean because I wonder, and I should do research on this, what's the correlation between CBA and BHP? Is there a negative correlation? It would be interesting to do that. Trenny says, just starting tuning in, what moving averages do you use? Okay, so daily chart, I tend to focus on the 25 and 100-day moving average. Sometimes I will have a look at the 200-week or 200-day moving average, and I'll just show you something really interesting. So this is daily chart this is on the 200-day moving average. So this is daily chart, and I noticed Shape Australia bounced off the 200-day moving average in April. Genus Plus bounced off the 200-day moving average. Superloop bounced off the 200-day moving average. I went through this the other day and went, wait on, should I be looking at the 200-day moving average a little bit more or using it or incorporating it a little bit more? Because these three companies, all three share price bounced off the 200-day moving average. Catapult, look at that, perfectly bounced off the 200-day moving average. It's like, is this just a coincidence? That's four companies in a row. And as I went down the list, even Solver, it's bouncing off the 200-day moving average. QBE, bounced off the 200-day moving average, not perfectly all the time. You can see back in August of last year, it went below the 200-day moving average for a while, but I was not trading it then. Email payments, this is where you don't see it, but it is above the 200-day moving average. So what I was thinking, you could incorporate the 200-day moving average and only buy positions when the share price is above the 200-day moving average. Maybe not sell it when it goes below, but only buy positions when the share price is above the 200-day moving average. So I'm going to do more research on that, but I typically use the 25 and 100-day. This is just personal preference. That's it. It just works for me. That's it. And when I look at weekly charts, I do tend to focus on the 200-week moving average. And the reason I do that is I tend to focus, where is it? It's gone. When I look at the weekly chart, it's more for long-term positions. So a long-term position would be, say, the American companies. So Amazon. There he goes. This is what I tend to focus on. And I use that because that's a good buying. If I see a high-quality company, share price move towards a 200-week moving average, that could be good buying. Hopefully, I have answered your question well. Oh, interesting one from Ben Hutchinson. He was intrigued. He went down a rabbit hole yesterday. I'm really happy that he got out of the rabbit hole because it was probably a tight fit. Because rabbit holes, I think, are fairly narrow. So Ben Hutchinson must be quite thin or small. My estimate of, I'm joking, of course. My estimate of production in silver quarter 3. Silver miners on ASX, nothing, no ounces. Copper diversified producers. So he does verify that South 32 is by far the biggest silver producer. Adriatic Metals is just behind South 32, but they've been bought out, I believe, or under takeover offer. Sandfire, Aries Resources, AIC Mines, and Hillgrove. So those other silver miners, the silver miners on the ASX, they're not in production. They're not in production. But if silver prices keep on going up and up and up, those companies should benefit as well. Worth being aware of who on the ASX actually increases cash flow with the rising silver price. But again, yeah, if silver prices rise, all boats lift. All silver boats lift. So all these non-production silver miners should benefit from that as well. And I'm just talking about share price. I'm not talking about cash flow or financials. Just talking about trading it. Okay, I'm going the wrong direction there. Aaron Briggs says, Nappy, do you think Telix is a good buy at the moment? Okay, 2 thoughts about this. What or why do you want to buy or would you want to buy Telix? Is it for the long term? Is it an investment? Is it a trading position? Is it for the short term, medium term? So that's probably a very important point. What is your reason, thesis for buying Telix Pharmaceuticals, and when would you sell or why would you sell? So these are very 2 important questions that you have to ask yourself for every single time you purchase a company. Why are you buying the company? So for Telix Pharmaceuticals, so I do own shares in this company. So this is a long-term hold. Oh, the wrong index. So for me, this is a long-term hold. I discovered Telix, really not discovered, but I decided to buy Telix on just a quarterly cash flow report. And after I learned more about the company, I went, oh, this could be more of a long-term hold for me. So I bought at 666, share price now 24.44. So no reasons to think about selling. But because it's long-term, nothing bad happening with the company, no reason for me to sell because my thesis, my original thesis, has not changed. I think this company can significantly grow over the next 5 to 10 years. I think this company could become a behemoth on the ASX. Anyway, so that's my long-term thesis. But if I was just trading this, looks like maybe the uptrend has come to an end. So if I was just trading this, I wouldn't buy a trading position because I just don't like the chart right now. So it all depends on your reason for buying. Hopefully, I've answered your question to your satisfaction. Scott says SPK has been interesting one the last few months. I think, I could be wrong here. I think I've put Spark New Zealand into my technical analysis or technical update video for tomorrow. I have a feeling I've done that. Let's have a look. Let's see. Yes, I have. I'll talk about Spark New Zealand in my technical update video because I think the chart looks interesting. Vin Healy says, could BCI Minerals be one of the most beautiful compounding investments currently on the market? 1 billion market cap, 60-year mine life, 40 million EBITDA from 2027. Dividends already mapped out. Risk toward looks okay to me. One of the reasons I love this channel or doing these videos is because I get ideas. I haven't even thought about looking at BCI Minerals. It hasn't crossed my mind until I saw this comment. So BCI Minerals. So I've got to log in. BCI Minerals. I am going to believe what you said, everything you said. But if you want to do more research, I'm assuming they've done an investor presentation. There we go. 19th of May, investor presentation. I love presentations. I don't like when companies don't release any presentations at all. For instance, there's a lot of small companies who don't do it. I love presentations because I'm very lazy. And presentation should really, this presentation, I'm hoping, should spell out the company's plans in the future. And BCI, where's BCI? BCI has a market cap of, was it $1 billion? $1.01 billion. Okay. Vesta presentation. So I thought this was iron ore. Is this still an iron ore company? Did you mention that? I'm pretty sure this used to be iron ore, but I could be completely wrong. Salt. Oh, yeah, so I am completely wrong. I'm pretty sure it used to be iron ore. Salt, the hidden ingredient in everyday life. It's probably true. How we operate, salt, okay. Australia's largest solar salt operation and third largest globally. Impressive scale, over 100 kilometers, square kilometers. Look, Parramatta, go Parramatta. Boo, Manly. Positive salt market outlook. I've never even thought about salt. Salt prices. Where can I find salt prices? I don't know. Operations, construction. So they're not in operation just yet. I'm a little bit confused. Says quarterly highlights. Full-scale operations commence on 15th of April. Okay. So they're still talking about construction. So maybe expanding construction. Sulfate of potash. So they're in potash as well. Steady future cash flow. Okay. 255 million per annum average cash flow. Yeah, capital management, forecast available cash flow and debt repayment profile. Cash available after debt repayment, a fair bit. Operating cash flow positive from 2028, free cash flow positive from 2028. Roadmap to revenue. Whoa, gee, okay. So this is the reason I love this channel because you give me so many ideas. I've never even thought about this company, but this does look intriguing. What about the chart? Looks like I put a purple box there as a resistance zone, and the share price has gone above that zone. Oh, the chart looks really good as well. There you go. Thank you. Thank you. Something to think about. Whoever wrote that. Where was it? Vin Hilly. Thank you for that. There's Simon PT, another person asking about Bell Potter's analyst top picks for 2026. Okay. Last two questions. This video's gone on for a while. With Middle East tensions, asking killer name, and tariff wars coming to an end, do you believe gold will breach 5,000 Australian dollars and trend downwards? And then more HN, I believe it's weak at the moment and will go to 5,000, then go to 6,000 Australian dollars by year end. I'll give you the simple answer. I have no idea. No idea at all. Because if I try to forecast what gold's going to do, there's a 50% chance I'm going to be wrong. I have never been a gold bear, gold bug, never been any sort of bear or bug on any sort of commodity. I don't really care about potential supply, demand, uh, what do you call it, deficiencies or whatever in the future. Uh, I've seen people try to forecast a price of any commodity in the past and be completely wrong. Be completely wrong. I think it's a full game. So I just tend to rely on the charts. And right now, gold still looks okay. The price of gold has pulled back a little bit last week or so, but doesn't really mean anything right now. Gold's still in an uptrend. Maybe there will be a little bit of weakness in gold prices because of decreased tensions in the Middle East, but who knows what's going to happen in the next year? We could see increased tensions. We could see something happen which could send the gold price higher and higher. So I do tend to just look at charts. For instance, copper chart looks really good. Copper chart has the potential to look really, really good. Uranium chart, however, looks the best. This is a chart or the sort of chart I'm looking at. This chart looks brilliant. So simple answer is I have no idea. Because if I say something, give a prediction on gold, more than likely the opposite's going to happen. Another way you can do is just go with the trend. Just say, well, if gold prices are in an uptrend, more than likely it's going to keep on going up until the trend stops. And Tinker Table Thanks for your videos. Could you please revisit LOT chart? Thank you. Is this Lotus? Lotus? Is this uranium? Lotus? Lotus Resources. Is it uranium? For some reason, I think it's uranium. Am I right? Uranium? Explorer? Exploration development of uranium project in Malawi and Botswana. Maybe we could work for Lotus and get some of those. We get a good tour of Botswana, some safari or something. Okay, Lotus Resources. So I just actually mentioned that I do like the uranium chart. And I do like some charts. I took a trading position in Paladin because I'm now bullish on uranium just because of the chart. And this is Paladin, looks really good. I do prefer this chart over, say, Boss Energy. Boss Energy ran up really quickly. It still looks good, but Boss Energy looks good. Paladin looks good. Some of the other ones starting to look good as well, including Lotus. So Lotus is starting to turn, I think, positive. Definitely, if the share price gets to 22 cents, I think it's breaking out. So I don't mind this chart for Lotus. And I am bullish on uranium. So that means I'm bullish on Lotus. And that is it for today's video. If you have any questions, any thoughts, leave those in the comment section of this video. Otherwise, I'm not a financial advisor. If you need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.